I'm 99 years old, and 5 years ago, I made a young woman quit her job. She was 28, working 60 hours a week at a consulting firm, and she had saved $8,000 over 3 years. $8,000. That's all she had. She asked me if it was even worth investing such a pathetically small amount. Those were her words. Pathetically small. I looked her straight in the eye and said that $8,000 is more valuable than my first 100 million. You have access to opportunities right now that I would pay $50 million to access, but I can't because I'm too big. She thought I was being kind. I wasn't. I was telling her the mathematical truth that Wall Street desperately doesn't want you to understand. Having a small amount of money to invest is the single greatest advantage you will ever have in your entire investing career. And you're about to waste it by copying what billionaires do today instead of doing what billionaires did when they were broke. Let me tell you about a letter I received in 1959 that changed everything about how I think about small money. It was from a man named Henry, a school teacher in rural Nebraska. He had read something I wrote about investing and wanted advice. He had saved $2,000 over 8 years of teaching. $2,000. His entire life savings. He asked me what he should do with it. Should he buy blue chip stocks? Should he put it in bonds? Should he wait until he had more? I wrote him back with an idea that sounded crazy. There was a small furniture store in Omaha that was struggling. The owner wanted to retire. The business was profitable but tiny. Too small for any bank to finance, too small for any investor to notice. I told Henry to offer the owner $1,500 for a 20% stake in the business, with an agreement to help run it on weekends. Henry thought I was insane. He was a school teacher. He knew nothing about furniture, but he trusted me, and he made the investment. That furniture store is still operating today. Henry's 20% stake has paid him over $600,000 in distributions over 65 years. His children inherited the stake when he died. They still receive checks every quarter. $1,500 turned into $600,000. Not because Henry was a genius, but because he understood something that most people never figure out. Small amounts of money deployed intelligently in spaces that large investors cannot access can generate returns that become mathematically impossible once you have serious capital. Here's what keeps me awake at night. I can never make that investment again. Not because the opportunity doesn't exist, but because I'm managing billions of dollars now, and a $1,500 opportunity is meaningless to me. I have literally been priced out of the best investments I ever made by my own success. That young woman with $8,000, she can still access these opportunities. She can still find the tiny cracks in the market where large institutions cannot fit. She has the advantage that I lost 40 years ago. And if she wastes it by buying index funds and waiting for her money to grow at 7% a year, I will haunt her from my grave. Drop a comment right now with your city and exactly how much money you have available to invest. Even if it's only $500. Even if it's only $200, even if you're embarrassed by how small the number is. Write it down. Promise me you'll watch every single word of this video, because I'm about to share the 3 specific principles I use to generate 50% annual returns with amounts so small that my current net worth makes them invisible. And I'm going to show you exactly why these same principles become mathematically impossible to execute once you cross certain capital thresholds. The young woman who takes time to understand this might be richer than you in 20 years. Not because she's smarter, not because she works harder, but because she understands something about small money that most people never figure out until it's too late. There's a conspiracy of silence in the financial services industry about small amounts of money, and I'm going to break that silence right now. Why? Because I'm 99 years old. I have no business relationships to protect. I have no products to sell you. I have nothing to gain by lying to you and everything to gain by telling you the truth before I die. The conspiracy is this. Financial advisors and investment firms want you to believe that small amounts cannot generate meaningful returns, that you need at least $10,000 or $50,000 or $100,000 before you can really start investing, that until you reach those thresholds, you should just keep your money in a savings account earning nothing. They need you to believe this for two reasons. First, they cannot make enough fees managing $5,000 to make it worth their time. So they want you to wait until you have more. They want you to save up. They want you to delay, because delay benefits them, not you. Second, and this is the part they will never admit, they genuinely don't know how to invest small amounts profitably. Their entire training, their entire infrastructure, their entire career is built around institutional scale investing. They literally cannot access the markets and opportunities where small money generates the highest returns. So they pretend those markets don't exist. The truth is exactly opposite. Small amounts of money invested intelligently in the right opportunities can generate returns that are not just higher than large amounts, but returns that are mathematically impossible for large institutions to achieve. Warren Buffett, the greatest investor of our generation, has stated publicly and repeatedly that if he were managing small amounts of money today, if he had $1 million instead of $100 billion, he could easily generate 50% annual returns. Not 5%, not 10%, not 15%, 50%. Why? Because he would have access to thousands of opportunities that are completely worthless to him at his current scale, but would be spectacular for someone with $1 million or less. The opportunities don't disappear as markets get bigger. The opportunities disappear as your capital gets bigger. Your small amount of money is your ticket into a world that billionaires are permanently locked out of. The mathematical reality that nobody explains to small investors is this: you don't need to find opportunities that can absorb $100 million profitably. You need to find opportunities that can profitably absorb your $5,000 or $10,000 or $50,000. And that completely changes your universe of possibilities. When Berkshire Hathaway evaluates a potential investment today, we need opportunities that can productively put at least $3 billion to work. $3 billion, that's not a typo. We cannot even look at an opportunity unless it can meaningfully move the needle on a $100 billion portfolio, which means we need investments that can absorb billions. This requirement eliminates 99.9% of all businesses and opportunities in the world. We can only invest in the very largest companies that are covered by hundreds of professional analysts, traded by millions of investors, priced very efficiently by the market. Meanwhile, there are literally thousands of small businesses, local opportunities, and specialized situations that would be perfect for someone with $10,000, but are completely useless to me. Let me paint you a specific picture that illustrates this exactly. There's a small car wash in suburban Ohio, family owned for 35 years. The founder just turned 72. His kids don't want the business. He's tired. He wants to retire. The business generates $180,000 in annual profit. It has no debt. The equipment is paid off. The land is owned free and clear. And he's willing to sell the whole thing for $400,000 because nobody else has made an offer. That's less than 2.5 times earnings for a stable cash-generating business. That's a spectacular price. Now, can Berkshire Hathaway buy this car wash? No. The opportunity is too small. We would spend more on legal fees evaluating it than the entire business is worth. Can a private equity firm buy it? No. Their minimum investment is $50 million. This is beneath their notice. Can a wealthy individual investor buy it? Probably not. Anyone with $10 million isn't going to spend their time running a car wash in Ohio. But someone with $50,000, someone willing to put in the work, someone who could buy a small stake and help manage it, that person just found an opportunity to generate 30% or 40% returns for the next 20 years. These opportunities exist everywhere, in every city, in every industry. hiding in plain sight, ignored by everyone with money because they're too small to matter. But they matter to you because you're small, and being small is your superpower. The first principle of small investor advantage is this: fish where the big boats can't go. Let me explain what I mean by efficient and inefficient markets, because this is fundamental to everything. An efficient market is one where prices reflect true value, where hundreds of analysts study every detail, where millions of dollars flow in response to any new information, where finding a mispriced opportunity is nearly impossible. Apple stock is an efficient market. Google is efficient. The S&P 500 is efficient. Thousands of the smartest people in finance spend their careers studying these investments. The prices are almost always right. An inefficient market is the opposite. Few people study it. Information is scarce. Prices are often wrong. Opportunities hide in plain sight. That car wash in Ohio is an inefficient market. That furniture store in Omaha was inefficient. Small businesses, local real estate, specialized niches, anywhere the big money cannot fit. Here's the mathematical reality that governs all investing. Your potential return is directly proportional to the inefficiency of the market you're investing in. In an efficient market like the S&P 500, you can expect maybe 7 to 10% annual returns over the long term. That's not bad, but it's not life-changing. In an inefficient market, where you have genuine information advantages and prices are frequently wrong, 50% returns are not just possible. They're common for people who do the work. The tragedy is this: most small investors spend all their time fishing in the most efficient markets in the world. They buy Apple, they buy index funds, they buy whatever stock CNBC is talking about that day. They're competing against Goldman Sachs and Renaissance Technologies and every hedge fund on Wall Street. They're fishing in waters where billion-dollar boats have already caught everything worth catching. Meanwhile, the inefficient waters where they could actually catch something big, those waters are empty because nobody with real money can fit there. When I was starting out with tiny amounts of capital in the 1950s, I read through Moody's Industrial Manual, page by page, thousands of pages, looking for companies that were so small, so obscure, so ignored that nobody else was paying attention. I found companies trading below the value of the cash they had in the bank. I found companies paying dividends that exceeded their stock price. I found opportunities so ridiculous that I could hardly believe they existed. They existed because they were too small for anyone with real money to notice. The inefficiency was created by their size, and their size made them perfect for me. Today, the same opportunities exist. Different forms, different markets, but the principle is identical. Fish in inefficient waters. Go where the big boats can't fit, and you will catch things that billionaires can only dream about. The second principle of small investor advantage is going to make your financial advisor scream. Don't diversify. Concentrate. I can hear the objections already. Charlie, diversification is the only free lunch in investing. Charlie, you're telling people to gamble. Charlie, this is terrible advice. Let me explain why those objections are wrong for small investors, even though they're right for large institutions. Diversification is a strategy for managing risk when you have so much capital that protecting it becomes more important than growing it. When you're managing $100 billion, a 50% gain doesn't change your life. But a 50% loss destroys you. So you diversify. You spread your bets. You accept lower returns in exchange for lower risk. That's rational when you already have more money than you could ever spend. But you don't have $100 billion. You have $8,000 or $20,000 or $50,000. And at that scale, diversification is suicide. Here's why. If you have $10,000 and you spread it across 20 different stocks, you have $500 in each position. If one stock doubles, you made $500. Congratulations. You can buy a nice dinner But if you concentrated that $10,000 in one or two opportunities you deeply understood, and those opportunities doubled, you made $5,000 or $10,000. That's meaningful money. That's wealth building money. That's the beginning of real capital. The math is brutal. When you're small, diversification guarantees that nothing you do will ever matter. You'll have tiny positions in dozens of things you don't understand. And even if some of them perform spectacularly, the impact will be meaningless. Every great fortune I've ever studied was built through concentration, not diversification. Warren Buffett didn't build his wealth by owning 200 stocks. He built it by concentrating in a handful of opportunities he understood deeply and betting big when the odds were in his favor. Bill Gates didn't diversify his Microsoft shares into a balanced portfolio. He held on and let concentration work in his favor. Jeff Bezos didn't spread his risk across different e-commerce companies. He bet everything on Amazon. Concentration creates wealth. Diversification preserves wealth. And when you have nothing to preserve, when you're starting from small amounts, concentration is your only path to something meaningful. Now, let me be clear about something important. I am not telling you to gamble. I am not telling you to put your money in things you don't understand. I am not telling you to take reckless risks. I am telling you that spreading your ignorance across 20 different investments is not safety. It's the illusion of safety. True safety comes from concentrating in things you understand completely and deeply, from knowing more about your investments than anyone else, from having such thorough knowledge that the risk isn't really risk anymore. Henry didn't diversify when he bought that furniture store stake. He concentrated. He put most of his money in one bet, and that bet paid off for 65 years because he understood what he was buying. That's the second principle. Concentrate your small capital in opportunities you understand deeply. Make your bets matter. The third principle is the hardest one to accept emotionally, but it's mathematically irrefutable. When you find a truly great opportunity, swing for the fences. Don't take small positions. Don't hedge your bets. Don't be timid. Bet big. I know this sounds reckless. It's not. Let me explain the math. In your investing career, you will find maybe 5 to 10 truly spectacular opportunities. Opportunities where you have a genuine edge, where the odds are heavily in your favor, where the downside is limited and the upside is enormous. These opportunities are rare. They might come once every few years, maybe less often. When they appear, you have two choices. Choice one, you can make a small, cautious bet. Put in 5% of your capital. Feel safe. Minimize your risk. And when the opportunity plays out exactly as you predicted, you'll make a nice return on a tiny position that barely moves the needle on your net worth. Choice two, you can recognize that this is one of the rare moments when the odds are genuinely in your favor. And you can bet 30% or 40% or even 50% of your available capital on it. The people who build serious wealth from small amounts always choose option two. Always. I've made most of my fortune from maybe a dozen big bets over 70 years. Not hundreds of small bets. A dozen big ones. Moments when I saw something others didn't. When the odds were overwhelmingly in my favor. And I had the courage to bet meaningfully. Warren is the same. He talks about his 20-slot punch card. The idea that you only get 20 investment decisions in your entire life. If you had a card with 20 slots, and every time you made an investment you had to punch one slot, you would think much more carefully about each decision. That's how you should think about investing small amounts. You don't need to make 50 bets a year. You need to find 2 or 3 truly outstanding opportunities and bet on them with conviction. Most people do the opposite. They make tiny bets on everything. They spread their capital so thin that nothing matters. They're so afraid of losing that they guarantee they'll never win. Fear of concentration is the single biggest reason small investors stay small. They have the chance to build real wealth, but they're too timid to take it. That's the third principle. When you find something truly great, swing for the fences. Make it count. Here's the specific implementation strategy that ties all three principles together into a system you can execute starting today, with whatever amount you have available. Even if it's only $1,000. This is exactly what I told that young woman with $8,000. And it's what I wish someone had told me when I was 25. Step 1. Choose one specific domain where you can develop genuine, world-class, expert-level knowledge. This needs to be narrow enough that you can realistically become the smartest person you personally know in that specific focused area. Don't try to be an expert in the stock market. That's too broad. Don't try to master real estate. That's too broad. Don't try to understand small businesses in general. Too broad. Choose something much more specific and focused. Maybe you work in healthcare. So you decide to focus exclusively on small medical device companies with revenues under $20 million. Maybe you live near a major university. So you focus exclusively on student housing within 2 miles of campus. Maybe you've managed restaurants for 10 years. So you focus on distressed restaurant businesses in your city that might be for sale. This specific domain doesn't matter nearly as much as choosing something narrow enough that you can actually master it completely over time. Step 2. Spend the next 12 months minimum becoming the absolute expert in your chosen domain. Read every book, every industry report, every trade publication, every blog, every research paper you can find about your domain. Talk to every person you can find who works in that industry or invests in that space. Visit every business or property you can access. Build a detailed database tracking every opportunity, every transaction, every comparable sale. Most people skip this step completely because it's hard work with no immediate financial payoff. It's honestly pretty boring. But this is where you build the knowledge that will let you recognize outstanding opportunities when they appear. When Warren was starting out, he read every single page of Moody's Industrial Manual twice, cover to cover. This unglamorous, tedious work of building deep expertise is what separates investors who generate 50% returns from investors who generate 5% returns. Step 3. After at least a year of building expertise, wait patiently until you find one opportunity that meets strict criteria. An opportunity where you have genuine informational advantage over other investors. Where the price is obviously wrong based on your expertise. Where you understand exactly why it's mispriced and what will correct that mispricing. Where you can clearly articulate what could go wrong and why you think it won't. This patient waiting might take 3 months. It might take 6 months. It might take a year or 2 years. Don't force it just because you're anxious to put your money to work. The worst investments happen when people feel pressure to act and settle for mediocre opportunities. Keep your money in treasury bills, earning risk-free interest, and wait until you find something perfect. Step 4. When you find that perfect opportunity, bet 25 to 50% of your available capital on it. This will feel terrifying the first time you do it. Your friends will say you're crazy. Your family will worry. Financial advisors will tell you you're violating every rule of prudent investing. Ignore them. If you've genuinely done the deep work in steps 1 through 3, if you truly understand what you're buying better than almost anyone else, if the opportunity genuinely meets your strict criteria, then betting meaningfully is not reckless. It's the only rational choice. Step 5. Practice absolute, unwavering patience while your investment works. This might take months. It might take years. It might take a decade. Henry's furniture store investment has been paying him for 65 years. Warren's early investments often took 5 or 10 years to work out completely. The modern disease of checking prices daily and panicking over short-term volatility has destroyed more small investor fortunes than any market crash. If you've bought genuine quality at reasonable prices after doing serious work, time becomes your friend and patience becomes your competitive advantage. Don't check prices daily. Don't panic during corrections. Don't sell just because something went up 20%. Just wait. Let genuine quality compound over years and decades. I'm 99 years old. I've spent 7 decades watching people invest money in every conceivable way. The ones who build serious, life-changing wealth starting from small amounts all follow the same pattern without exception. They develop deep expertise in one narrow, specific area. They fish in inefficient waters where big money can't fit. They wait patiently for genuinely outstanding opportunities. They bet heavily when those rare opportunities appear. And they hold for years or decades while their investments compound. The ones who stay poor or build wealth slowly do the exact opposite. They spread themselves across many different areas they don't really understand. They chase tips and trends and hot stocks they read about on the internet. They make tiny token bets on everything so nothing matters. And they panic and sell during inevitable corrections. Your $5,000, your $8,000, your $20,000, whatever you have right now, is genuinely more valuable than my first 100 million, because you still have access to all those inefficient markets, all those concentrated positions, all those big swings on compelling opportunities that created every fortune I've ever seen built. Don't waste that advantage by pretending you're an institutional investor. You're not. You're small. And being small is your superpower, if you understand how to use it properly. That young woman I talked to, she quit her consulting job 3 months later. She took her $8,000 and bought a small stake in a struggling cleaning service company near her hometown. The owner was 68 years old and wanted out. She spent nights and weekends learning the business, finding new clients, improving operations. Within 2 years, her $8,000 investment was worth $60,000. Within 5 years, it will probably be worth several $100,000. That's what small money can do when it's deployed intelligently in inefficient markets by someone willing to concentrate and swing for the fences. The opportunity is yours. The advantage is yours. The superpower is yours. Don't waste it.